All right, everybody should be here now. We have officially started the class. Let me spotlight myself for everybody. How's everybody feeling today? 1, 2, 1, 2, 1, 2. How's everybody feeling today? Woke up well? Everybody ready to go? Ready for another week? Good morning. Good morning. I know you guys are excited for another week, another opportunity. Be ready in the chat. I'm feeling great. I'm feeling great. We're gonna do something. I'm feeling really good. Feeling great. Feeling ready to get back out there. We got a full week in our hands. I ain't gonna lie, I hate when we have short weeks and short days, throws us off. But it's good to get some rest, definitely. Feeling well rested, ready to go ahead and get us kicked off here with this watch list today. So I'm excited. Um, I definitely would love to make sure that I can do a couple of things for you here. So first things first, I'm sure the fellas will get a kick and some of the ladies as well too. Right? We're gonna run through and we're gonna do our picks of the day, right? So our picks of the day, we're gonna switch things up a little bit here. So I know we got some Falcons fans in the chat. Listen, I am not a Falcons fan. You guys know where I reside, but I am not a Falcons fan. So I'm gonna give you guys my picks for the day. I know we got some West Coast people, right? So you see the games. We're gonna do the picks of the day. We got these games all lined up. So let's see how many of them actually pan out, right? So first pick, we got San Francisco versus Cleveland. In Cleveland, do we got anybody residing in Cleveland? I know we got some San Fran people. That's not a question, right? But how many people we got? Anybody in Cleveland? Anybody a Cleveland Browns fan? And I know the chat probably gonna be a little bit quiet, but we got a from Cleveland, Miss. Okay, so I'm gonna say this: rooting for Shadur, but we'll lose to San Fran for sure, for sure. So I'm gonna say this: I um I think that today my pick is that the Cleveland Browns win. I'm sorry, guys, San Fran. My pick is that the Cleveland Browns figure out a way. I think Shadur leads them to victory, but I believe that really it's more so about the defense, right? I believe it's more so about the defense. So I'm gonna go with Cleveland today. I think it's more so about the defense. I think they'll upset them, and I think Shadur make just enough plays, right? Just enough plays today. But I think it's going to be a tight one. Jacksonville, Tennessee, Trevor Lawrence, I guess. This game is abysmal. But Jacksonville, Houston, and Indy. Now I'm an Ohio State fan. For those that don't know, so CJ Stroud's my guy. Indianapolis. This is a division game. This game honestly could go either way. Um, but CJ's just coming back off injury. I would say this: Houston's defense will win them the game. I like Houston today. Shout out to my boy Will Anderson. All right, New Orleans and Miami. Well, this ain't a toss up, but we like Miami at home. Now Falcons and Jets. I'm laughing for a second here because listen, man, if y'all can't figure out a way to beat the Jets led by Tyrod Taylor, no disrespect to my brother, but come on now. I think I'd be remiss if I took, the Jets today. I ain't even gonna do that. But I like Atlanta. Carolina and the Rams. Now, this is a game to watch. I know we got some people that's in LA. As you guys know, it's tough to travel across, when you're going from West Coast to East Coast, especially for a 1 o'clock game, it's a little tough, a little tougher. Um, I'm gonna go with the Rams though, just because I just don't think Carolina be able to score enough points. So that's the reason why I'll go with the Rams today. I think this would be it may be a close one just because of that travel, that little jet lag that the Rams might be on, but I think they'll be 10-2. Next one, we got Tampa and Arizona. I like Tampa at home. Simple. Shout out to Miss Sonia. Keep it simple. I like Tampa at home. Shout out to Jacoby Brissett for Arizona Cardinals. Really good brother. Minnesota and Seattle. This is a tough place to play. Give me Seattle. Las Vegas and Chargers. Give me Chargers. They'll just run the ball on them. Buffalo, and we got Buffalo and Pittsburgh. Well, Josh Allen's been turning the ball over too much. Give me Buffalo on the road. Mason Rudolph, like you just said, ain't gonna be able to show up in my opinion. Then you got Denver and Washington. I like Denver. Right. So we round about the list again. I like Cleveland. I like Jacksonville. I like Houston, Miami, Atlanta. Rams, Tampa, Seattle, Chargers, Buffalo, and after that, like Denver on the road tonight. So those are your picks, right, for your NFL teams. So Rodgers is playing today. Okay, but that's I'm gonna change my pick then. If Rodgers is playing, I'm gonna go with Pittsburgh today. I'm gonna change my pick. Thank you for that, Dennis. I'm gonna change my pick. So I'm gonna go with Pittsburgh today if Rodgers is playing. So that's pretty much it. All right. So just a little fun there, but let's get into business now. So we got our economic calendar here today, right? So let's look at it. We touched a little bit on it yesterday, but we got a delayed data week, right? So just to kind of update you guys, right? So a delayed data week on Friday, we're getting numbers from September. The only number we'll get from November, numbers we'll get from November will be realistically on Wednesday, the ADP numbers and the ISM services report at 10 a.m., right? So we definitely are looking at that. The ADP numbers, expecting to see, are we seeing a slippage, a decline? These numbers have consistently came out. The PCE numbers are going to be behind all the way from September. So we're late in that regard, right? So we do definitely are late in that regard as far as these numbers, right? So did want to highlight that. That's our numbers for the week. Stocks to pay attention to that I want to focus on, especially for this week. We're going to kick things off with MSTR. So I want you guys to take these notes down. I started to post something about MSTR yesterday, but I actually want to post it now. I said I'll wait till the watch list to actually go ahead and post it. So let me go ahead and grab this real quick and drop it in the chat. In a second. Here we go. It's posted in the chat for us so everybody can see. These were my notes, particularly some of the notes that I had on MicroStrategy. So I just wanted to let you guys know. So two things that I just want to bring to everybody's attention. So bottom line, this is pretty much the message that I want to stress. MSTR coming down there to that $100 to me is going to be probably the best price that we get on it. $100. Now, MSTU is going to split. So I wanted to provide some education as to what is going to happen. So essentially, you are going to get let's say you have 1,000 shares, right? That 1,000 shares is going to turn into 100 shares, but MSTU's price will go to $10, right? So it will go to about $10, right? So excuse me, $12, right? It'll go to about $12, right? So we are going to see MSTU 10x in share price value, but you are going to get your shares, 90% essentially your shares are going to be turned into, right? You got 1,000, you're going to turn into 100 shares, right? So 1,000 shares, you're going to turn into 100, 2,200, 3,300, and so forth, right? So just giving you that example. Now, when that happens and you go to $12, right? Essentially, I was telling people not to purchase any more MSTU until 75 cents. Realistically, once this split happens, that means do not touch MSTU until $6 to $7 again. So that's essentially what I was meaning. I wanted to make sure that there was no confusion by anything that I was saying. So $6 to $7, right? I definitely can't wanted to make that known, right? And so I wanted to make sure that everyone could see that, right? So definitely wanted to you know, stress that to you guys. So $6 to $7, really $7.50 is going to be equivalent to 75 cents here pre-split. So is everybody clear on that? I want to make sure that everyone is clear on that. All right. So everybody is clear that 75 cents is going to turn really into $7.50, which means realistically, I don't want you to buy any more until it hits $6 or $7. So don't touch MSTU, right? I know they're going to go through their reverse split. So do not touch it until $6 to $7. Now, as far as MSTR, where do we see potentially price going? And also BTC, right? So now we can, there we go. Appreciate that. Now we can actually get into, right, this particular equity. So let's break it down here, right? So when we are looking at MSTR right now, currently we're at $177. We also keep our eyes on, and I'll remove MSTU. Let's look at BTC, which over the holidays, we did see BTC had a small retracement. I think we talked pre-holiday and said, hey, we maybe see this thing going back to about 89K. We did get that. So the floor right now is about 80,000, right? So if we break below that 80,000, I can imagine MicroStrategy probably be coming down there to 160, right there around 160, maybe getting down there to 150. So you do want to watch MicroStrategy if Bitcoin does pull back down and breaks below. One thing to remind people about when it comes to MicroStrategy, it's not just only going to just go up when Bitcoin goes up, but it also comes down a lot faster than the way Bitcoin does, right? So I do want to stress that to you guys is that it is tied, of course, to the performance of BTC because MicroStrategy is the biggest holder of Bitcoin, right? But it is important to note that when it does come back down, the volatility swings are pretty large, right, for MSTR. So sometimes MSTR can go into oversold territory way before we see any significant decline here with BTC. So that was just something I wanted to make note of. I know there was a lot of particular questions, when it came to Bitcoin and as well MicroStrategy's relationship. So this is the reality of how MSTR actually moves. BTC once again, is MicroStrategy is the biggest holder of Bitcoin. So it tends to, just like when on the upside, it tends to run super fast when BTC runs. Now, the thing is, like I said, around there, around $100, this is more of, even though we have MSTU, MicroStrategy in itself is all leverage based, right? They've pretty much mortgaged everything they've had to be able to buy Bitcoin, right? They don't leave no cash around. They put it right into Bitcoin. So that's the risk that you do take when you are investing in MicroStrategy. It is a high risk investment with a high chance of reward, right? So this is high risk, high reward, high risk, high reward. So I wanted to stress that there. Next thing I want to go through, you may have seen me active yesterday. Talk about a couple things. So two things that I wanted to showcase, right? So I wanted to go through this just to make sure that people understand a few different things. Understanding investing, right, in what profit-making businesses and loss-making businesses and the risk behind it all. So I want to want people to understand these couple of things, right? So why would you go ahead and invest, right? Of course, it will be worth more in the future. It has real value, real earnings, real purpose. You are comfortable holding it through ups and downs. So when you're looking at a profit-making businesses, this is the main thing that you should be paying attention to, right? A profit-making business is a company that earns more than it spends. It has positive cash flow. It can grow without needing consistent funding, right? Rewards shareholders over time, gives ROE, return on equity. Examples of what strong businesses have in common: consistent revenue growth, positive earnings, high margins, strong balance sheet, real products and demand. Keyword on this: real products. And also, there's demand for those products. These companies survive market corrections and thrive in bull markets, right? Now, loss making businesses, and then we're going to go back real quick. A loss making businesses is not automatically bad. Some may just need time to actually scale, right? So that's important to know, right? Not just because a business may be losing $3 or $2 EPS a year doesn't mean that they're a bad business. They may need time to actually go ahead and scale to push themselves all the way to the upside. So that doesn't mean necessarily, like we said, it does not mean that they are bad, right? So I do want to take that notion away. Doesn't mean that all loss making businesses, I know sometimes you hear me say, yo, this ticker is trash. Well, that's after they've proven themselves that they can't get the job done, right, over a period of time. We come to that conclusion that, yo, this company can just not get right. Like Beyond Meat, that's trash, right? Hot garbage, right? Beyond Meat shouldn't even probably be traded on this market no more, but it is, right? Not every company that's worth less than 2 billion is trash. They may need time just to scale. But there's some things that I want you to understand about the risk. Because I know that a lot of times we see these, I may mention maybe about 2 to 3 weeks ago, when you start to see your tickers mentioned on Twitter as the next this, the next that, that's usually where the most danger actually is, right? When the tickers that you're investing in start to be talked about, like, hey, these are the next this, the next that, that's usually the most dangerous time, right? When you're actually looking, as from a long term investor perspective, right? So, understanding the risk, they spend more than usually they make. They rely on investors' debt and dilution to survive. If the economy slows, they get hit hard. If rates stay high, their businesses become more expensive to run. These can still produce massive returns only when bought at the right price and held for the right reason. So I want to stress that because we always talk about, hey, what's a fair price to pay? When with loss-making businesses, I just want to put this out there and you put this on your notes. With a loss-making business, when the stock market is at an all-time high, it's usually never the right time to buy it. We've seen names like OKLO, which have came down 50%, yet the stock market is still relatively up, right? So the riskiest businesses, anytime a disaster comes, usually they're the first names to go. And this is why valuation matters, right? Understanding valuations is going to matter, right? So I do want to stress that to you guys. So anytime I come on and we're talking about, hey, valuations matter, valuations matter. I'm not just saying that just to hear myself talk. I'm saying that because genuinely, I want to be able to protect people from seeing massive downsides, right? Because a lot of times you might get involved in an investment and you may not understand exactly, okay, what is the exact risk here? What is my risk to reward? The risk is not same for every particular investment. Most people lose money when they're treating every stock the same. The money that you have in Caterpillar should not be the same money that you have in SMCI. You don't want to get overexposed to names that, once again, haven't proven themselves, right? But every company carries a different level of risk. Low risk company, strong earnings, strong cash flow, low debt, steady demand, and they're also market leaders. Medium risk, they make money, but earnings fluctuate. What do we mean by earnings fluctuate? Well, when you go ahead and take a look at the earnings history, last quarter they beat, this next quarter they missed. The previous quarter they beat, the quarter before that they missed. So they're splitting, they're fluctuating. Industry competition is very high. Valuation is elevated. What's one of the main metrics that we like to use to define and understand one piece, not to say that's the only piece, but one piece is we can base a business model's valuation, is it elevated or not, off of one simple metric, and that's a price to earnings ratio. So when we see the P to E ratio higher than 30, right, that means that its valuation may be elevated. Now, just because it's higher than 30, it may be 40, 50, 60. That's elevated, but that's not extremely high. Extremely high is when you start to get over 100. Once you get over 100, 200, 300, that means you're really trading where you shouldn't be. And that's where we get into more of the higher risk. Now, let me talk about this. High risk investments usually come with no profit, high debt, consistent dilution, right? Also, you have cyclical industries, right? So interchangeable, right? Very interchangeable. They move in cycles. And then reliance on the overall market liquidity. Let me speak to that real quick. The stocks that only go up when the market is going up are the stocks that are usually the highest risk. I'm going to say that again. If you notice that there's days when the stock market is down, but yet there's a ticker I'm about to throw out there, pay attention. Notice that the market been coming down, but what's been going up? Eli Lilly, LLY, right? Notice the names that have still found a way to maybe still go up or stay up, even when the market was getting rocked a little bit. Those are your names that usually are not in need or reliance of the market overall to go up. So that's something important to pay attention to. And that's what we call relative strength, right? So I do want to say that that's what we call relative strength, right? So relative strength is once again when we can actually see stocks go up without needing, right? Once again, when companies do not need, right, the overall markets to push higher in order for that individual equity to go upward. So once again, stocks that can go up without needing the overall markets to push higher. All right. So that's something once again, something important to note and to just bring to your attention. Right. When you don't need the overall markets to actually push higher. So they don't rely on the market liquidity. What is our job as an investor? You must be able to clearly identify, is this a real business that prints profit? These are the questions you should ask before you put your money into a company. These are the 4 questions that you should ask. Is this a real business that prints profit or someone that just slap AI behind their name and say, hey, we do AI now? I've shown you different companies that have rebranded themselves. Nebis, just an example, ticker NBIS. Go look at them. They used to be Yandex, but now Nevis comes out and reinvents themselves. Not saying that Nevis can't be successful, but you will find those bad apples. If you notice, every time we go through a boom and a bust, right? When we go through the boom period, you have companies that try to reinvent themselves and say, hey, we do this now. We do AI. That's the new norm right now, at least for right now. Hey, we do AI. Hey, we got to deal with open AI. Just because you got to deal with open AI, I can't wait for open AI to come because I think Google's going to eat their lunch, right? I can't wait for open AI to come to this market and think that they can come to this market with $1 trillion valuation. You OpenAI had better be careful because Google is already ahead of them, and we see why Google's running a 4 trillion because this company has been here a while. You can come up with all these cute deals. You got a deal. I got a deal, right? Will it last? That's the main question that hasn't been answered yet. Number 2, is this a company that loses money and depends on the market? Right? There's some companies that honestly depend on the overall market going up, right? We just discussed that. Is this a company that's losing money? So you understand the risk. Key word here, identify. I want you to be able to clearly identify. Number 3, is this really more of an investment or a gamble? Well, you think about quantum computing. Quantum computing is a big gamble. To me, it's not really much of an investment right now, not when there's not profit making actually happening. It's really a gamble. When you put your money inside JPM, Goldman Sachs, Caterpillar, that's not gambling. That is an investment. When you put your money inside Home Depot, that is an investment. When you put your money inside Microsoft, Google, Apple, that is an investment. When you put your money inside Palantir, it is an investment. Even though they may not have the best valuation, that is an investment. The last thing is you should be able to identify clearly, right? Is this a good risk to reward? What's the risk to reward here, right? Is the risk worth the reward? That's the last thing that you should be asking yourself when it comes to this investment. Is it worth this risk to reward? All right. The last thing that I said. So, yeah. Any questions from anybody? Questions, questions, questions. Now's the time to go ahead and speak. Here's your questions. Get your questions in. Questions, questions, questions. Nate has a question. Go ahead, my brother. Questions, questions, questions. Go ahead. Now's the time. Can you go over C3 AI? No problem. I'll do that now. Questions, questions, questions pertaining to the tickers. Well, excuse me, pertaining to the information. We'll have time for tickers. I will get this ticker, right? But any questions? when you spoke about relative strength, mentioning XLV, right? Healthcare, Eli Lilly, when spoke about relative strength, you mentioned correct. Yep, we did speak about that. That ticker has what? A higher asset allocation. So when tickers have higher asset allocations, once again, they tend to be able to move just fine, right? Overall in the market. So that ticker had a higher asset allocation. So, yep. I plan to ask though for questions myself about C3 AI. How do you decipher if retype that question for me? Mandy had a question. You look at how its products or service can integrate itself with other companies, right? Someone asked me, how do you find it or a good price for a company? So let's actually do all of that in one because all these questions roundabout, let's answer them all at one time. And we can simply do that. I'm gonna get one ticker. I'm gonna get the C3 AI ticker. Let me get AI real quick. Funny enough, their ticker is AI. So we're talking specifically about long-term investing. So as you can see here, you need not, this is just a good example. I'm glad that he asked me about this. This is the company that falls under what category, right? High risk, low risk, or medium risk, right? High risk, low risk, or medium risk. Which one does C3 AI? Gambling. Thank you. Thank you, Austin. High risk. Exactly. Incredibly high. I can't quantify this investment based upon anything. Looks horrible. It has too many blanks. Thank you for that. Too many blanks. So I can't really justify the company has no forward PE. What does that mean? When a company does not have any forward PE, what essentially does that mean? Well, now since this company has no forward PE, I can't really quantify this name, right? I can't quantify because it doesn't have any earnings, right? So when you are taking a look here, this is, no expectations. That's not the type of company I want to have my money wrapped up into, right? That is not the type of money that I want to have my money actually wrapped up into is a company with relatively no earnings, right? Keyword, no earnings. This is a stock that, to me, once again, does not have a stock, once again, with does not have any projected really earnings here. So I'm looking here and they can't prove themselves. Now, when I go to the margins, right, this is one that particularly, as we see here, they do have 711 million in cash. So they do have some cash. They can weather the storm there. They don't have a lot of debt. So when a company's in this situation where they don't have anything to offer, you're buying this thing purely off of a gamble. I'm glad that Austin came in and said that. Now you also have the shares short outstanding, right? You got 29% of the shares that are actually being shorted, particularly here of this investment. So 29%, right, is what we're going to see here. So that's about 3/10, particularly of this whole float size, right? So this whole float size, 3/10. Of that, you got 134 million shares outstanding. So this is considered to be a low floater company. This is a low float. Now, anytime a stock has less than 500 million shares outstanding, we consider that to be a low floater. So we would put this in a category of a high risk investment. You already understand up front, listen, this company doesn't really have anything to really offer me today, but it's stock price, but it's cheap price. This is where most people go wrong. Now they're saying, well, I got C3 AI and it's 14 bucks. This thing could go to the moon. Not so certain on that one. Why? Because the company doesn't offer you really much of anything, right? So I do think that this is very important to look at. This is not a stock that you should take your money and invest in and expect a significant return right away. I do want to stress that this is nothing that you can expect to last. When the market starts to turn up, this is nothing that you can expect to actually hold up, right? This is nothing that you can expect to actually hold up here. So when the market actually is starting to drop, this would be one of the first stocks to actually go ahead and drop. All right. So I do want to stress that to you guys, so you guys know this is once again, when you're looking at the equity and saying, hey, I'm really not too sure on if I'm supposed to invest in this. This is like a no-go, unless you are willing to assume the risk. Once again, you must be willing to assume the risk with these particular type investments. You shouldn't be putting your money, house money does not ever belong in an investment like this. House money does not ever belong in an investment like this. This is incredibly high. This is incredibly high risk. Incredibly high risk. Yep. Those are my thoughts on that. Let's get another ticker and let's talk about fair value price, because someone asked, okay, what's the process of actually examining where you should be looking to pay for a ticker? What's a fair price versus what's an expensive price? So we use technicals and we use fundamentals to be able to define, because you may have a fundamentally sound price, but we're going to use ticker ALAB, right? Astria Labs Inc. All right, we're going to use this ticker real quick. Now, this is a profit-making company currently right now, $1.21 EPS. So anytime you want to get the P to E ratio, what are you doing? You're dividing the earnings, right? You're dividing the stock price by the earnings. That's what you're going to do. The price divided by the earnings. So if you notice here, things are a little bit better. Now, back in September and December of 2024, they didn't have no trailing PE because they weren't profitable. Now they are profitable and they do have some forward expectations as well too. Now, at least back then they had some forward expectations here. So there's something that maybe you could account and say, hey, forward thinking wise, they do have some expectations. That would be a good example. Now, if there's a stock that may not have a trailing PE, this is an important thing to note. Write this down. You can only have a trailing PE if you actually have earnings. So keep that in mind. So if the company doesn't have earnings, they can't cook the books and say, yo, this is our P to E, because you don't actually have earnings. You're negative. But you can always have a forward PE, which is a good thing. So at this point, back here in when you were actually taking a look back here, they were actually going ahead and buying stocks, right, off of what? They were buying stocks off of the forward P to E. So they're buying this thing off of a forward, right, price, right? They were pricing this name and buying it off of a forward expectation. So that's important for, like I said, that's important for us to note. A lot of times investors are purchasing tickers, once again, not because of what the stock is doing today. And this is something I say all the time to people, right? Very rarely, in my opinion, do people buy equities because of what the stock is doing necessarily today. Usually they're buying it because of what they expect, right, for it to do in the future, especially when it comes to tech companies. So if you notice back here during that time, 2024, it ran towards the back half of 2024, right? Went all the way from $40 all the way to $150, but then sold off here in March and February, right? Now the stock's back here. It's a really good point. It actually came back here and pulled back down here to 137, and it currently is at 157, right? So I had a decent size pullback here not too long ago. Now I do want to go to particularly, I want to take, right, a couple of, let's actually take this stock price and let me show you how we actually like to play around with it. So you have a forward PE of 67 currently here. So now what I want to do is I say, okay, well, if the stock price was to come down to, let's just say, this is where we play around with it, and we say, okay, well, ideally, if the stock price was to come down here to $60, where would the P to E be? Right. And it's relatively easy math because you are taking, right, the past 12 months, $1.21. So let's say at $60, let's divide that. That's easy math. $1.21. You should come out with 49. Ideally, once again, we want stocks within 30 to at least 30 to 15 price to earnings. So realistically, there would not be a perfect price until this stock got honestly back to here. Now we understand that tech stocks usually don't give you, for the most part, don't usually give you perfect prices for really too long. Like this has not been a name since its existence that is really traded at the $40 level for too long. But why is that important to know? Where did I get that number? Once again, all I'm taking is the stock price. Let's take $40 and we divide it by $1.21. Someone's going to ask, where did the $1.21 come from? Once again, this is what the business has earned the past 12 months. So I'm taking what the price of the equity would be if it fell, dividing it by its earnings, and valuing it that way. So that's the way that I look to try to find, once again, perfect prices. I take what the business is currently earning and I divide it by a price that I would be looking to pay. So now I know, push come to shove, there's nothing between 40 to 150 where I would really be paying a fair price. So that's out the woodworks right there. So I know that now. Nothing between 40 to 160 am I paying a fair price realistically for this ticker. I would be paying somewhat of an overvalued price even at $60. Not much, but a little bit, around 49 P to E. So now that I understand that, I now am going to say, okay, well, is this an investment that I'm willing to take a chance on? Here's the first step is evaluating where I would be paying a fair price. There's no fair price on this ticker unless it's lower than $40. I just looked back. This stock has not traded underneath $40 pretty much in its entire existence. Fine with me. Now, I go ahead and take a look at what are its forward expectations. Now, you have a 67 P to E. So what does that tell me? That tells me that earnings for the next year are anticipated to grow. Why is that? Because if the forward PE is lower than the trailing, and I say this thing all the time, but I think some people just not taking notes, so please take this note. If the forward P is lower than the trailing, what does that mean? That means that the earnings are projected to increase. Because if the earnings is increasing and the stock price is staying the same, for example, if I take 157 and instead I divide it by two instead of $1.21, what's going to happen? That P to E will be lower, right? Because that means that the earnings, which was $1.21, increased to $2 in that example. So now you can come here to this analysis tab, right? Very simple. So now you have your earnings estimate here up top, your revenue estimate here up top, right? So next year, what the average estimate is $2.37. This current year is $1.78. That's what it's expected to earn after this final quarter, right? Of this year. We're expected to do $1.78, right? A year ago, pay attention, they only did 84 cents. So the question that was being asked, this is a company that's obviously showing us year over year earnings growth. So why would it, the main question that's asked is why would an investor be willing to overpay for A-Lab? They're willing to overpay for A-Lab. Why? Because a year ago, they did 84 cents. This year, earnings are anticipated to close out at $1.78, right? Then you have next year, which is going to be $2.37, right? So now this is what we could call a company that's having now 3 years of consistent earnings growth, 2024 to 2025 to 2026. So when I talk about 2026 being the year of put up or shut up, this is what I describe. Your earnings have to begin to justify this price. Now, this is an average estimate of $2.37, and this is found underneath your analysis tab. So what the tabs that I went to summary, statistics, analysis. Write that down. Those are three main tabs that you really should be looking at. And then the fourth one would be company profile. If you don't know anything about a specific company, come to the company profile and learn, right? Get some data, figure out what's exactly come here, hit their company website, boom, learn exactly what's happening and going on. So this is why, once again, summary, statistics, profile, and analysis. Those are the four main tabs that you need. Now, because of this estimate, this is making investors say, even as the stock price drops, because there's some questions in the chat. You got to listen to everything I say. Please don't listen to respond. Listen to jot this down to tie this all together, right? When you are looking here, the stock price is at 157. Now, this is where we tie in the technicals. Once again, if the stock price was to come down, we just did the math. We said, yo, at $100, right? And $60, we did the $60 math and said, $60 would not be a bad price at all to pay for this company. But if the stock price was to break down to $188, we would take that metric. Now, here's what you could do. Let me show you. The EPS is $2. This is the average estimate. So for next year, $2.37, right? So what you could do is say, if A-Lab pulls down to $100, we're just going to use $100 as this example, and you divide that by $2.37, you should come out with roughly around 42 P to E. Now that would be a trailing or forward P to E. What would that be, a trailing or a forward P to E? If I took $100 in the share price and divided it by 237, would that be a forward or a trailing P to E? Thank you for that. Forward, correct. That would be a forward P to E. So now you'll say to yourself, okay, if this stock came back to $100, and this is what the average estimate, once again, this is just an estimate. So you do understand that, but that's a forward estimate. This will be your forward P to E. So you say, man, at $100, yo, I might not be able to pass that name up. That's a good price. So when people ask and say, okay, well, how would someone be able to evaluate off of forward metrics? This is why certain stocks pull down and they never, they hit these levels and they reverse out of there super quickly, because people use their forward metrics to say, this is probably not a ticker that I want to pass up here. And once again, this is a growth company. It's different than a value name. So growth companies have, once again, these huge forward projections. So now you've seen in the past 2.5, almost 3 years, where A-Lab has actually been on the right track. So that leaves you more comfortable to be able to say, you know what? I'm going to put my dollars in the A-Lab here at $100. Does that make sense to everybody on why someone would do that? Does that make sense? Perfect. Now we're going to do it with another company just to make sure it makes sense. Let's use Hood, Robinhood. This is a good example, right? Robinhood's one of the top stocks that people want on this market right now. I would argue it's probably in the top 25 just as far as stocks that people want to go ahead and purchase. But let's use Hood. Hood is a company right now that has a trailing PE. TTM means you're trailing 12 months. TTM. So this company has earned $2.40. So write that down. $2.40 EPS, right? So $2.40. Now, when you look here, right, this company, $2.40. Let's go to the statistics tab here. And when you look here, its forward PE and its trailing PE are pretty much about equal there in that regard. So not much of a change as far as difference wise. Now, if you look here, its average estimate is $2, right? Excuse me, for the complete this year, right? For it to be $2. A year ago, they did $1.56. This year, it's an average estimate of $2. Next year, the average estimate is right around $2.35. So your average estimate comes from, once again, what's the number right in the middle between your low estimate and your high estimate? So you got $2. Once again, you got $2.35, like $2.35 for your average estimate. It's going to come in because analysts are going to weigh in. You have a number at 18, they're going to take, the average, right? So they're going to take that average, right? So that number is usually going to kind of somewhat be in the middle of where, they've pretty much came in with their estimates. Now, that's only a 35-cent increase, essentially. But let's look as far as seeing what would be ideally the price right here on Hood. So when we look at Hood, and I was mentioning, okay, around 60, if you remember a couple weeks back, I was saying, hey guys, $60 to $70 would be the no-brainer price to get Hood? Well, let's do the math on that. If we have 60 divided by 2, what's that, guys? 30, right? 60 divided by 2 is 30, right? So when people ask me and said, hey, what was I basing that? And now if I use the $2.35, that'll make the P to E even lower. So at 60 bucks, divide that by $2.35, that'll give you 25 forward PE. So if the stock price was to go to $60, of course, it's not doing that tomorrow, but just giving you that example, right? Let's say Hood found its way back to $60 and it's currently did $2 in EPS, right? Expected this year, right? To finish out this last quarter, and they hit that number, the P to E would be what? 60 divided by 2 is what? 30. Easy math there. Easy math. So that's how we identify. We use technicals to say, okay, where do we actually get the move from? And then we also play around with the prices to say, okay, ideally, if this stock was to come back to $60, would this make sense? And at 60 bucks, it would. Stock earning $2 in EPS, $60 price, be a perfect price, essentially. Not a bad price to pay. Then as far as technicals, we just said, hey, if we were to continue to break down below 100 and found our way back here to 66, once again, this is us looking at the price and saying, where would be the ideal price for us to pay? So now there's no kind of like really guessing. And it also takes the fear part away, right? So I'm going to put up both of the tickers that we just went over, right? Now it takes the fear part away. We'll pull up A-Lab and Hood, right? So if A-Lab came down here to, once again, 80 bucks, 60 bucks, and if Hood came down here to 60 and 50 bucks, I want you to think about the fear part. This is important because it's easy when things are up to say, oh man, this is a great investment. It's much harder when things are down, because what I would say from an emotional standpoint, I want to check this, because usually when stock prices are down, people look at how much it fell in the past 3 months. Notice that. Notice when the stock market is up, people talk so much about the future expectations, right? But usually when the market comes down, people talk more about what just happened. Don't you guys notice that? If the market was to slide for 3 months, you think the conversation would be on what's going to happen next year? What's the growth? Or, oh my gosh, they're going to beat up and talk about how the stock just fell 50% in 3 months, right? They're usually going to talk about the negative, not knowing that, once again, you should be looking at, this is how you look at the positive of when the market comes down. This is how you should look at the positive of when the market comes down, right? They will talk like it's the end of that ticker, 100%, right? If Robinhood was to go from 120 to 60 bucks, they'll be saying Robinhood is crashing. If A-Lab is to go from 160 bucks down to 60 bucks, they'll be saying A-Lab is going to get delisted soon. I'm just using these as hyperboles right now. The point that I want to make is, right, like they did 2 years ago with Nvidia, right? 100%. It went from 346, it dropped to 107, and they said people weren't buying their chips. That's why I'm trying to get people to understand is like, yo, when the market comes down, all of the negative connotations, anything that they can throw, they're going to be talking about it. But this takes away the part of, oh my gosh, the ticker dropped $60. But now you understand, okay, the stock did pull back $60. But what effectively am I buying? A stock that's earning $2 EPS a year, that's 60 bucks, that's a good buy. A-Lab coming down to 60, 80 bucks, earning what they're earning, that's a good buy. So now you understand, okay, the price that I'm paying and what am I actually getting myself into? Because when the stock market is at these highs and you're overpaying for these tickers, you get caught. Once again, if the market pulls back down, you get caught holding the bag, right? You do get caught holding the bag if the market pulls back down. So does that make clear sense to everybody? Everybody's good with that and understands that exercise. What did you say it meant? When the forward PE is less than the trailing, that means that the earnings are anticipated to increase. If the forward PE is higher, that means that the earnings are expected to drop. Yep. Now you know. So now the tickers that you're looking at, and you say, hey, this is a company I'm interested in. Let me run this valuation metric by this ticker before I put my money into it. So now you can clearly identify and say, okay, am I overpaying, underpaying? You could be underpaying, right? And that's a good thing. Underpay is a good thing, right? Because that means that the stock is trading way cheaper than where it should be. Or are you pretty much paying a fair price? Fair price is the fair price. An overpay is an overpay. Now, the question that I know that's going to come in, we want to get all these questions. The question that's going to come in is what? What if the stock is literally just overvalued and I want to buy it? That's fine. I just want you to understand what you're paying. Once again, you're not going to always get a fair price from these overvalued companies. And that's understandable. Fair prices don't always happen. Usually, fair prices come when corrections happen or bear markets happen. That's why they don't last long. It makes sense now, right? Because when things correct or bear markets come, now you're not going to be paying a overvalued price. You're usually getting a fair price. Consider this, right? The word correction. In order to have a correction, that means that something has to be out of balance, right? Because the market's at an all-time high and majority of the tickers are trading at these premiums, there has to be a correction to correct those prices. So honestly, when stocks like Hood and A-Lab and these other tickers that are high flying off the rope, they have to correct. When they do correct, that brings them back down to a valuation that makes sense. So a correction to me is nothing that people honestly should be afraid of. A correction just means that you were trading out of balance in the first place. And now it's time to bring you back down to reality. So that's where reality creeps in. That's where reality checks in. And 100%, hopefully that made a ton of sense for everyone here listening today. Yep. Any questions? Any questions before we move on? ETFs don't have earnings. But as far as pullbacks, ETFs don't have earnings because ETFs are not just individual companies. Any final questions on anything? You do have those, you do have that guide right here that you can actually take a look at. So you do have that guide right there. Next thing that I want to actually go to is I want to cover our cybersecurity names. As you guys know, tomorrow is what? Cyber Monday. So funny enough, I wanted to make sure that there was a couple of things that I went over. And these are just really, pretty much you have your top 12 right here. Cybersecurity names, not necessarily in any order, but these are the top 12 names. Number one is CrowdStrike. And CrowdStrike, I actually have something for you guys. I actually didn't put it in the chat, but I'm going to put it in the chat now. Drop that for you guys real quick. I just dropped my CrowdStrike predictions. So you have Zscaler, ticker ZS, Palo Alto Network, Fortinet, Cloudflare, Net. I know they just had a little outage, a couple outages that took them up a little bit, but nothing crazy. Technology do what it do. 7 is Okta. That's a sleeper here. CyberArk. You also have Checkpoint Software, Rapid7, Datadog, and Snowflake. Right? So that is your 12 there. Particularly here, Datadog's had a pretty good year. They're one of our top plays last year, going into this year, right? Snowflake, as you guys know. So these two have had a pretty great year. We expect more from them here in the near future. So put these names down and did drop those for you guys. Right. But now I want to get into our predictions, right? So I created these four. There we go. So I want to go through this. So I've done a little bit of the work for you, right? In this case, ZS right now I believe is at 251. Best price, I believe, for Zscaler would be right around 180 to 220. My 2026 target for Zscaler is 350 to 375. So you can put that down there. 350 to 375. Hello Alto Network, best price scenario. We actually did get that not too long ago. It was a few months ago. Best price scenario would be 140 to 160. My 2026 target is pretty simple, 240 to 250. All right. Now, FTNT, my best price for them, currently they're right around 81 bucks. Best price for them is right there around 55 to $60. My 2026 target for them is going to be 110 to 120. All right. Then you also have Snowflake. My best price for them is going to be 170 to 200. But my 2026 target is going to be 300 to $320. We got an overhead resistance around 270, 280. If we can crack that, Snowflake is going to be cooking with fish oil. So those are my thoughts on Snowflake. All right. So you do have that there for you. And next thing we do have is CrowdStrike, our 2026 predictions, right here on CrowdStrike. So I really broke this thing down. I had to create something whole, just separately, right? So here's I won't say it's a bold prediction because we've been calling CrowdStrike to 1,000 since it was $100 stock. So CrowdStrike's a $500 company here now. CrowdStrike, $700 target for 2026. So if you're looking at CrowdStrike, one of the fastest growing cybersecurity companies on this market, on this planet, but what most people look over is the structure of the company itself. So here's a couple of key points, right, that I do want to make sure that you guys can actually do, right? So number one, CrowdStrike only has 250 million shares outstanding. Right? So this matters directly more than people understand, right? So a company with a low outstanding shares, low float, and they actually have a positive and growing business model, right? This is something that I do want to stress to people, right? When we are taking a look here, very, 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 very important for me to discuss. And when you do look at particularly this, when demand increases with a low floater, I wouldn't be surprised to see once CrowdStrike makes it to maybe $700, $800, they could end up splitting maybe 1,000. We just seen Netflix just split. So this was the first time that Netflix had, well, not first time, second time that Netflix has split. So they could be in line, right? We very well could see this name go ahead and provide us with a split, right? So I do say that when you do look here, I do anticipate that eventually, sooner rather than later, that they will provide us a split. Now, will that be at 700? I can't really define that. We'll just see when it happens. So I do want to put that on your radar. Now, CrowdStrike has been scaling aggressively, right? Higher recurring revenue, extremely high net retention, and expanding into identity security, cloud security, right? And AI threat detection. This combination to me gives a really great long-term business model. Now, I want to talk about number three, because if you look, CrowdStrike hasn't been consistently profitable. They've been more on the medium side risk, right? They've been the one that 1 second they're in profit. Next second you're like, okay, what happened? How did you wet the bed here? So they've had up and down movement wide, right? 1 second they're making a actual profitable type move on a consistent basis. The next second, right, they're not, right? So what I want to stress is particularly when I look here, this is one that has high institutional ownership. We do have good long-term price targets, but the company has lost $1.22 EPS over the past 12 months. But CrowdStrike is next year projected to turn profitable. So what does that mean when we are taking a look at Crowd, right? They are projected to turn profitable next year. So if we're looking here at Crowd, this is, like we said, still a name that is trying to figure themselves out, right? On a consistent basis. Like I said, 1 quarter they're profitable, the next quarter they're missing, right? And so now what I would say is we did see this with Netflix, funny enough, Tesla, Nvidia, Shopify. Once they cross sustainable profitability, the stock price continued to drive upward. So when you have a low amount of outstanding shares, right? And that's underneath your key statistics tab. CrowdStrike only has 250 million. The market cap can very easily get moved upward. That's how CrowdStrike has these 20 and 30 and $40 days. So I do want to stress with Crowd, right? That this is a name with a $700 price target for 2026. Now, cybersecurity spending is entering a massive expansion cycle. So they have quantified that and already listed those things out, right, for 2026 and 2027. That CrowdStrike to me is in a perfect, like they've done a lot of spending. I do want to speak to that. Over the past 2 to 3 years, they spent a lot of money to put themselves in this point. They've already pre-projected that 2026 and 2027 would be their years, right? From a profitability perspective. So they told us that back in 2023 and 2024. They told us that, hey, 2026, 2027 is when we expect to really be turning profit on a consistent basis. So you might be saying, okay, well, the stock is still losing money. Why has that went into the stock price moving upwards? Remember what I said in the beginning of all this. I said people buy businesses off of what? Forward profit expectations, right? People buy businesses off of forward expectations, not necessarily just what they're actually earning today. So CrowdStrike to me is in a perfect position right now to strike. Now, what's some of the main reasons? Once again, low float. That's one of the top ones. Profitability inflection. They're at that point. Explosive ARR growth, right? Sector leadership. CrowdStrike has a chance to take over the sector next year as defining themselves as the clear leader, right? So all those things happen. I think that they are going to be able to put themselves in a great position. So I like this company. Look at this company as being one of, like I said, one of the top stocks in the cybersecurity space, and they're only going to consistently grow. So I strongly believe that CrowdStrike has the potential to push towards $700 next year. So that is my claim on CrowdStrike here, $700 a share. Yep. Yep. Any questions? Questions, questions, questions. Questions, questions, questions. Mandy, no problem. We'll make sure the recording's in there. How do we look for low float tickers? That's a good question to ask. Here we go. Good question to ask. So you come directly to everything that you want to find as far as float, right? Share statistics will be right underneath here. All right. So underneath share statistics, right? So EPS wise, EPS 786 million, right? Shares outstanding, 786 million shares outstanding, right? That's how you're able to really see your shares outstanding, right? So here, this is Robinhood. Robinhood is not necessarily a low floater. It's not really a high float we consider to be over a billion. So it's kind of right there in the middle. So this is where you get that data. So anytime you want to look to see how many shares outstanding, if I wanted to look and see, okay, well, with SoundHound, how many shares outstanding? The main reason I'll say this, the main reason why people are attracted to these cheap tickers is because they usually have low floats, right? Usually your SoundHounds and all of these names for the most part, I can imagine, and I haven't even looked at these names, but let's just take a look here, right? Let's dissect. You see these 19% mover, 15, 12. The only company I know on this list is CleanSpark, and that's just from a time ago. But let's just see if I'm right about that. TMC Metals, I'm sure it's a low floater. I can almost guarantee it is. Yep, it's a low floater, 413 million. EXK, right? Right here. Endeavor Silver Corp. I don't even know what this is. I'm sure it's a low floater. It is 294. AG, right? Anything less than 500 million. So all of these names, let's see, right there, 490. Cool. IE, no CleanSpark's one. 144 million. So a lot of times when we see these massive moves, this is what attracts people to those tickers, right? Just and this was a good case in point to make. What attracts people to these cheap tickers is usually they have a small amount of outstanding shares. When you have a small supply of something, what can you usually do? A small amount of supply, what are you able to actually do? You're able to do what? Manipulate, right? You're actually able to manipulate the stock price, right? You're able to manipulate the stock price. All right. So that's something, like I said, very, 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 very important to note, right? You're able to go ahead and manipulate the stock price, all right, very quickly. So when you do have, like I said, a low floater company, you do have those low floats, right? Low floaters. That's how we can actually see these names actually go ahead and move. All right. So, yeah. Any questions from anybody? Questions, questions, questions. Get your questions in. Yeah, no problem. Y'all enjoy y'all service. We're gonna be wrapping up here in a second. Any questions? Any questions? Questions, questions, questions. Speak now, forever hold your peace before I move on. Once I move on. Yep, yep, yep. PDFs are posted directly right here in the books and PDFs tab, right underneath information and resources, right here. Right under here. You got all of the PDFs that I referred to today, all of them right here for you, right there for you. When on earnings calls, how do we actually gauge guidance? Um, So I mean, those are key things right there. So as far as gauging guidance, either the company is going to increase their numbers, profit expectations, revenue expectations for the next year, or they're lower. So as far as gauging it, you just mark down, hey, did the company increase, decrease, or keep the same? That's how you would gauge it. Increase, decrease, or stay the same. Those are the three ways that you can gauge it. If a company's increasing their earnings expectation, usually they believe that something's actually going to be pushing upward, right? For that specific company. They're high on what the numbers that they're seeing, right? In that specific quarter already from maybe some companies, depending on when they report, they could already have the bulk of their numbers actually in. So it also depends on when the company reports. They obviously have the numbers, right? To be able to tell you, hey, we're expecting a good quarter based upon what we're seeing here right now. Or we're expecting a not so good quarter. Uh, Mm-mm. Speaking of low float, you haven't covered MVMI. I just covered it last week. What do you want me to cover about it? Because my thoughts haven't changed. It's a low float ticker that we believe it's going to 400 and $600 here soon. So what about it do you want me to cover? How do you feel about Netflix after the split? So we see more downside. So I'll get that. Netflix and Google, I believe, was asked Google about 310. We'll see on as far as for Netflix right now. It needs to get below this 104. So I would really, of course, watch it like any other stock this week. But if we reject here at 108 and break down and make a lower low, 104, that'd be key. As your thoughts change on the green sector, I'm still building. Not at all. As far as for Enphase and Tan, no, not at all. It's just not going to take off right now. But no, my thoughts have not changed at all on that specific company. No, ma'am. Is NVMI a good price to buy now? Roughly, I would say if you're not in on NVMI right now, I would wait for a pullback to at least around 220 to 240 at least. Ticker Nova, NVMI is way too high for you to buy right now. So 220 to 240 ideally would be there. The best price actually hit, which would be 140 to 160. We got that price in that level, but the stock has obviously moved up since then. So I would refrain from buying NVMI at this time. I think not that necessarily, I think you're just completely overpaying, but it's just way too high. Like I said, 220 to 240. It is a low floater. It's extreme low floater. It's less than 50 million shares outstanding. So, yep, my thoughts. Stay abreast to your tickers. As far as MSTU, you probably missed the beginning part of this conversation, so it's no problem. I'll just repeat it again. MSTU, don't buy it until $6 to $7, right? $6 to $7 after this split. So when this split happens, don't touch it again till 6 to 7. With the VIX back below 20, should we be expecting the market to continue to the upside? It could very a lot will have to decide with this current interest rate decision that'll happen here the second week of December. Um, Questions as far as Uber. I don't think so. I don't think Uber will get to 100 by the end of this year. Unfortunately, we had high expectations. Not that Uber really disappointed us because they haven't wet the bed, but they just haven't moved. Right. 2026 could be a better year for them, but I still think Uber long term. It's not going to be the company to me. Uber won't be the company that goes to $300-$400. I see them even as they get over 100. I very well compare them to like a Palo Alto Network as far as trading, right? So they're more of the consistent kind of move little by little type company. That's how I compare them to. If I had to compare them as far as how their trading will actually move. Yep. 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 Do you see Palantir continue downward before they report earnings? We'll have to monitor that. Then as far as MU, if they get back below 220, they'll definitely pull back down again as well. So let's switch this up real quick. Someone asked me as far as particularly a stock, right? And it as far as like catching Bitcoin's movement downward, MicroStrategy would be your go-to. MicroStrategy and Coinbase, right? MicroStrategy and Coinbase would be your go-to tickers. As far as for Palantir, as far as movement downward, only below 148 are we going to see any more movement downward. If Palantir this week, I would watch it actually back above this 170 here. I think there's a chance that Palantir can actually rise this week if we get above 170. So we could take a look for Palantir to move back to 175 only if that happens. Yeah. Last ticker right now is Google, and then I got to get into what I need to cover. But for all the ticker questions, I would definitely stress like everything I taught you today, you should be able to actually go ahead and do that on your own now and evaluate your tickers. So for people asking about tickers, you should be able to go ahead and evaluate for yourself now, particularly as far as tickers wise, right? So I think I have Google finished charting on the side using on that. Particularly with I think Steven, you asked me about this ticker. We're actually to me, I'm glad I came to the 4 hour real quick. Looks like Google's actually in a bull flag pattern. So if you see that break above, now if we break to the bottom of this flag, it's key to note. My geometric key to note. If we do break the bottom of this flag at 316, then I would say, yeah, you could see probably Google come back underneath to about 306. So that is something that I would look out for. Right. So if you do see the break underneath, Steven, if you're still here, if you do see that break, yeah, if you do see that breakdown below that at 316, I would say yes, you have a room that would invalidate that bull flag, and you'll probably come down here to about 306. So yep, you'll come down there to about 306. To answer your question. Mm-mm-mm-mm-mm. Any other questions from anybody? Questions, questions, questions. Some of those tickers that you guys had put in, I'll jot them down just for, and then yes, this class will be saved. So yep, this class is being recorded and will be saved. So your ticker questions, I'll get those to you. So yep. All right, let me move into my piece now. I want to talk about a couple things for this upcoming week. First ticker want to do is AM Dizzle. So AMD ticker right now, watching for a couple things here this week. Let me go back to so AMD, we're looking right there. We actually shot right out of that 195. Price came right out of there. We're back up here to 217. So you did see the QQQ, which actually came, and let me pull up index on the side. Enough micro strategy talk for today. All right. So we do want to, because the SPY and the QQQ are both within the same positioning right now. Where currently, right now, funny enough, the QQQ is at here directly at. So you want to watch 622. I want you guys to watch that level 622 here on the SPY and the Q. So we did break over on Friday. We did get over that 614, 613 level. That had been an area where we rejected at here previously and pulled back downward. I'm gonna just take a couple of these things. We did pull back there a couple of weeks ago. That's when we seen that market drop. But the VIX did, as someone mentioned earlier, the VIX. We got our eyes on the VIX. Let me pull that up now. Set your alerts for 20 this week. Any downside action on the market will come once the VIX gets below 20. I mean, gets above 20, excuse me. So 20, anytime it breaks back below 20, you should always just set an alert or directly for 20, just so you know, okay, hey, when it gets back above that you can actually, you actually do know. And so what I do say is, particularly here, right, my number one thing that I would stress and say to you guys here, right here on the CBOE, right, on the VIX, is setting that alert for 20. Now, if we do break back below 613, and then you do have AMD right here at 213, you do want to monitor and watch AMD right here at $213. The $213 should be where you do pay attention to and watch. So you do want to monitor that area. Now, if AMD is to get back below 213, on the upside, on the downside level, you do want to watch 213 on that break. Now, if AMD gets back above 220, back above 220, it can move back to 226. So that'd be where I want you to look for and watch on AMD. All right. So AMD, look for and monitor and watch that specific area and level. So yeah. Austin, I think you had a question. So let's go ahead and get your question. Is it best practice to execute trades directly from your brokerage account or link your brokerage and trading view? So I do think it is good for you to go ahead and actually have your brokerage account actually set up. If you wanted to your trading view, it is something good, but I like it directly separate. I think it depends upon if you know that, hey, I don't like the extra steps. I prefer to just keep it separate though. I prefer to keep it separate. That's just my thoughts though. I prefer to just keep it separate. That's the way I've done it. But if you want to skip steps and just have it linked directly to, I don't think it's a bad thing. So I do think it's something that you can do. Yep. Yeah. So if you are only on one device, I would suggest maybe linking it because if you're going back and forth, but if you have multiple devices, I don't really think it's necessary. My thoughts on that. Questions, questions, questions. All right, we don't got no questions. Moving on. Let me get Meta real quick. Make sure that you take this down here on Meta. A lot of institutional buying last week. Meta, a lot of buying last week. Pushing the stock from 585. Funny enough, that Friday back up here. So the level on Meta to pay attention to this week is 652. If Meta breaks that 652, you want to watch them move back to 665. Okay, so for Meta platforms, if this is a ticker, either one that you're in. Also, you have METU. If you're looking at METU, currently right now it's at $31.62. Know that this was a recommendation of mine. We were looking for maybe less than 24, didn't get it. I know I purchased a few here, and I know a few people that did. So METU, watching Meta, the overhead resistance on METU will be right there at $33 this week. So $33. Next one to talk about is Apple. 280. Put this on your radar this week. 280 bucks. Apple's in the midst of breaking this weekly bull flag pattern. So ticker Apple looking for a break over 280 and actually a move higher. So $280 a share, move over 280. We're looking for a move higher. $280, right? 280. So I want you to put that down for yourself this morning. 280. Next stock is Just Print Money. You're familiar with it. Just Print Money here. Bring this back into focus. So two things to pay attention to with Just Print Money. We got an all-time high of 322. So on Just Print Money, we could be looking at a short-term call position this week on JPM. We like it with a break to the upside. If it can shoot over 316.50, I think we might be able to see a move back to 320. Those are my thoughts there. Next thing to talk about is pay attention to BOIL this week. So BOIL's has some overhead resistance here at 36. We're still looking for this. We're still here in the winter time. So we plan to be out of this trade by January or February. We want to see this move towards 50, right? So here for BOIL, a move upward to 50 and then 63. So we're still holding our position on BOIL. So you should have your alerts set there. Just wanted to cover the stock, the ETF today. But BOIL, those are my thoughts on it. BOIL, BOIL, BOIL. You should have all of those notes. Next ticker is going to be NVIDIA. So pay attention to NVDA this week. We're still stuck right now. If we do break through this 174 level, if we stay below that, we're going to head towards 170. For a short second last week, we went to that level, and then we came right back up and rallied. So do keep your eyes on that area. Next one is Oracle, and this is one I want to speak about Oracle from a long-term investment perspective and short-term trading. Around 140 to 120, 140, 160, that area, that $40 block, 120 to 160 is going to be a great price to pay for Oracle. So I did want to make that note. That is going to be a great price to pay for ticker Oracle, right? So that is one thing that I did want to say on ticker Oracle. Those are my thoughts. Oracle, great price. Now, as far as the short-term price action, below 198 and 191, you could see it's really stuck here within the middle right now. It's like short-term trading volume has been actually pretty sporadic on Oracle. So we haven't seen a consistent move just yet on Oracle yet. So like I said, we do want to make sure that we do go ahead and keep you guys in line on this name. But 120 to 160 is really a great price to pay for this equity. So should be the price you're looking to pay for this specific ticker. All right. 140 to 120, 140, 160 area, really good individual price to actually go ahead and purchase the equity. So that's our thoughts on it. So yep. METU, that's pretty much all the tickers for today. That's pretty much every ticker that we was looking to really just cover for right now. We'll finish up. We do have just as some alerts, some housekeeping things, just so everybody's aware. A couple things to look at. So the schedule, we're gonna go ahead and wrap this thing up. The schedule be the 1st to the 3rd, 9 a.m. to 11 a.m. sessions. So we won't be too hard to find. December 1st to the 3rd, 9 a.m. to 11 a.m. sessions. So I want you guys here paying attention. We will be on Zoom those 3 days, right? 9 a.m. to 11 a.m. first to the third. So the first to the third, you should be getting a Zoom code. That Zoom code will come directly here for Zoom code questions right here within the chat. Yesterday's class was recorded. I'll post that class and today's class. So you will get both classes. So I got you. You will get both classes. The one we did obviously yesterday and the one we're doing right now. You'll get those within the next few hours here. So if you needed to step in and step out, all good. All good. We got you covered. Yep. That's essentially it for today. I appreciate everybody for their time. Make sure you do review those guides, take these notes. But like I said, hopefully everybody's holiday was good, and super, super duper appreciative of you guys being here. I would definitely say the takeaways of this class will be to make sure you're using evaluation metrics properly. Touched a lot on in the beginning, focusing on how to pay a good price, right, for the companies that you're interested in. And really just so you understand, that's what I think is super important, right? If you don't know what you're buying, that does a disservice for yourself as well, right? If you don't understand, okay, where did I pay for the ticker? So now if the stock, let's say once again, if someone buys ALAB today, they understand that they are overpaying for the ticker. But now if it goes to 60, $80, you understand, hey, that's maybe a fair price here. We're getting to maybe closer to fair, right? 40, less than 40 is where you're going to really be saying, okay, this is, but we look at the stock price, we haven't seen 40, and we understand as to why you haven't seen 40. Remember, forward price businesses always trade more expensive, right? Forward price businesses are always going to trade more expensive. They're not going to be your Caterpillars and your JPMs that are going to trade in line, right? There's a difference between trading in line with what your business is worth versus trading future and forward expectations. So it's just important to know, like I said, we want to make sure that people know, hey, overpaid here. So now when the market comes down, there's not well, why did it come down? Or do you think it's going to come back? And all those questions that we always tend to get when you have the education up front of what you're putting your money into, it can also help you sit and say, okay, well, I know I overpaid here, right? So, like I said, a lot of times people have those questions, and I want to make sure that you are able to effectively understand how to get the answers right to your questions. I think that's what the most important thing here for me is, helping you dissect the answers. So, very appreciative of you guys. I'll shut this thing down so we can get this recorded.